Look, the brutal truth is that early-stage investments are a minefield nobody warns you enough about. You put your money, your reputation, your brain power on the line, and what happens? Hidden risks explode in your face, wrecking everything. Cap tables crumble, products fail silently, teams crack under pressure, markets shift overnight. It's maddening because you see the surface all shiny and promising, but beneath it lurks chaos. And yeah, it's infuriating how no one prepares you for what's really coming. First thing, blind trust is your enemy. The founder might sound charismatic, the pitch flawless, but that doesn't mean they're ready or honest about the real trenches ahead. Most founders are fighting their personal battles, shadows of doubt they hide behind polished decks. If you don't dig deep into their motivations, mental toughness, and brutal honesty about failure, you're setting yourself up for disaster. So demand raw transparency, not the rehearsed answers. Press them to show how they handle crises, what they actually think about their weaknesses. If they can't face that with you, run. Second, don't fall for the shiny metrics alone. Growth numbers, user stats, whatever. Those are the distractions. What you should obsess over is resilience, the team's ability to pivot, iterate, and survive when the playbook is garbage. Can they rewrite the rules on the fly, or will they crumble? How well do they hold under pressure? If due diligence ignores the human element, you're investing blind. Focus on grit, culture, mindset. These usually don't show up in spreadsheets, but they decide the game. Third, alignment means everything, and almost nobody nails it early on. Founders want speed, investors want control, employees want security, and these interests often clash underneath the surface. Without brutal conversations upfront about decision rights, expectations, and future vision clashes will explode later and bleed your time, money, and nerves. So force the hard talks now. Don't just gloss over legal terms. Dive into scenarios. What happens if it blows up or if one party wants out? Build a framework for conflict because it's coming. Fourth, don't get seduced by the narrative of the next big thing. The market is mercilessly niche and fragmented. That huge opportunity you see, often it's a mirage hiding volatile trends or stubborn incumbents crushing newbies. Challenge the founders. How deep is their market understanding? How quickly can they adapt when the market changes shape or when competitors respond? If their answer is fuzzy or rehearsed hype, it's a death sentence waiting to happen. Lastly, manage your own ego better than anything else. The biggest risk often comes from the urge to jump in fast, to be the smart investor who knows best. That arrogance kills more deals than bad products. Stay hungry for knowledge, but humble enough to admit when you're out of your depth. Build real relationships with other GPs, exchange brutally honest intel. This network won't just help you avoid disasters, it'll unlock opportunities no one else sees. If you do these things, demand unfiltered honesty, obsess over resilience and culture, resolve conflicts up front, brutally test the market assumptions, and kill your ego, you don't just survive early-stage investments. You turn unseen risks into calculated plays. This isn't about playing it safe. It's about seeing the cracks no one else sees and choosing to lean in anyway, knowing exactly how to handle the fallout before it even starts. That's how you win in this game. Not by luck, but by ruthless clarity and raw, relentless follow-through. Subscribe to our YouTube channel and check the featured link to discover more.